This presentation talks about the regulatory uh, uh, process that banks or other lending institutions, particularly banks, are under. They're regulated by FDIC, Federal Deposit Insurance Corporation, and then the Comptroller of the Currency if they're a national bank, or the State Banking Commission if they're a state bank. And they're regulated and they're examined on a periodic basis. In other words, the regulator, let's say FDIC, will send examiners into the bank. They will examine the bank from a lot of different perspectives in terms of how the bank is operating. But one of the things that they're going to be looking at is the quality of their loans. And so when we talk about the regulatory credit classifications, we're talking about how an examiner will look at a loan and whether or not they would potentially label that loan as a loan that has some weakness or needs to be taken care of. The credit classifications that we have there's four of these: special mention, substandard, doubtful, and loss. A special mention loan is one that has the asset, or the loan, which is the asset to the bank, has potential weaknesses that deserve some attention from management. The regulator would feel that if these were uncorrected, there would be a potential deterioration in the repayment capacity for that particular loan. Special mention assets are not really adversely classified, but they do expose the institution to sufficient risk to warrant an adverse classification. So a special weakness would be, I mentioned, would just be a case where the regulator says there's some weaknesses in this loan. It may need a little more collateral. You may not have up-to-date financial statements, those kinds of things that you need to take care of. And here's some additional verbiage that you might want to look at. Now, the next one is a substandard asset. In other words, it is inadequately protected by the current sound worth and paying capacity of the borrower. Most of the time, it relates to collateral. In other words, assets that are classified as substandard must have a well-defined weakness. That weakness that may jeopardize the ability to liquidate that loan and satisfy the debt. So the bank, if it is a loan is classified as substandard, that bank is going to, the lender is going to try to maybe acquire some additional collateral to back up that. They may take some steps in order to shore up any weaknesses that loan may have. One of the things, again, as we talked a while ago about the FSA guarantees, is an FSA guarantee is one way that the bank can come in and address a loan that could potentially be considered substandard. In other words, you've got a customer that has had a bad year, or they've had some carryover debt, their financial situation has deteriorated some. They're still a good customer. You'd like to keep them, but you know that whenever you're going to be examined, that this loan will be classified as substandard. You might want to seek an FSA guarantee in order to eliminate that possibility. Whenever you have a FSA guarantee, if it is classified as substandard, only the unguaranteed portion is considered to be substandard. So if there's a 90% guarantee there, 90% of the loan would be okay. Only in terms of the amount that was classified dollar-wise would only be the 10%. So banks often use the FSA guarantee in order to avoid getting a classified loan that's substandard. Again, some verbiage there that you might want to look at with regard to substandard assets. Now, a loan that's classified doubtful. This really says an asset classified doubtful has all the weaknesses inherent in one classified substandard, with the added characteristics that the weaknesses make collection or liquidation in full questionable and improbable. What it amounts to is that the regulator is saying here is that we really don't think that you're going to be able to collect this loan. There's some real weaknesses here, and so it's doubtful that you're going to be able to pay off the loan in full. There's going to be some losses. So they will classify it as doubtful. And this means basically that you need to move that, but you need to get that loan out of the bank because they're looking at this loan as being one that somewhere down the line is going to be considered a loss. Now, whenever a regulator classifies a loan as a loss, that's where they're saying we consider it to be uncollectible. We don't feel like that you're going to be able to collect this loan. You have to write it off. In other words, you have got to take it off your books. You try to recover any value you can as far as any collateral that you might be able to obtain and liquidate. But the regulator just basically saying we're not going to allow you to carry this loan on the books. You're going to have to write it off, take your losses, and go on. So that's one of the things about a loss. You really want to not get into those situations, but occasionally you have loans that go bad. What happens whenever a regulator classifies loans is that based on what classification they are, they will then have to be backed up what's called a loan loss reserve that the bank has to have. And so if the loan, and they have to have a loan loss reserve or capital that's been set aside for loan losses. But as they write off loans or take losses, it's charged back against that capital. And so what the classification process does is really saying how much of that bank's capital has to be set aside in a loan loss reserve. And it's based on the dollar amounts of these loans that are considered special mention, substandard, doubtful, or loss. As I said, loss, they're saying you have to get rid of that loan. It has to be written off. Now, whenever the regulator comes into the bank, they're going to do a credit risk evaluation. They're looking at the analysis of the borrower's ability to repay and support the supports provided by the structure of any credit risk mitigants. When analyzing the risk and the credit exposures, examiners are going to consider these various things. The borrower's current and expected financial condition. They're going to be looking at their cash flow, their liquidity, leverage, and free assets. They're going to be looking at the borrower's ability to withstand adverse or stressed conditions. And they're going to be looking at the borrower's history of servicing debt, whether they have historically had repayment problems. Historical repayment capacity is pretty highly correlated with a borrower's willingness to pay. So as we've gone through looking at financial analysis, you will see those things that we've been looking at that are going to be a part of what the examiners are going to be looking at when they look at that loan. The underwriting elements in the loan agreement, such as loan covenants and amortization and reporting requirements, are looked at. They want to look at those covenants. They want to look at the requirements that are put into those loans to make sure that the borrower is required to furnish current financial information, make sure that maybe they had to keep their insurance up, those things that we've looked at in terms of covenants, the loan covenants that they have to meet. They want to look at the collateral that's pledged. They want to know whether that collateral covers the loan amount. So they're going to be looking at the collateral values and what the liquidity of that collateral is. And then they're going to be looking at qualitative factors such as the caliber of the borrower's management and the strength of its industry and the condition of the economy. So they're going to be bringing lots of things into play whenever they're looking at these loans. But a bank that needs to, whenever they're going through their loan portfolios, a bank wants to look at where those weaknesses are and try to shore those weaknesses up before the regulators get there. Many of your bigger banks will have a self-regulating or self-examining group within their bank that are constantly looking at these things so that when the examiners show up, there's not problems that they're going to find. So the banks are trying to find any problems and correct those problems before the regulators do.